Hello, in this video we'll discuss Section 1245, Depreciation and Amortization Recapture. Now, before we go into the specifics and the rules that apply, let's talk about the problem and the solution of why we even have Section 1245 Recapture. Now, recapture just means recharacterization. We've been talking a lot about recharacterization rules when it comes to tax. Characterization is all about the character of the gain or loss. So if you recall from the general concepts video of characterization, there's really ultimately two different characters of gains or losses. There's ordinary and there's capital. Now within capital we can have long-term and short-term, but ordinary is just treated as ordinary. We don't have a distinction between long-term and short-term. If you also remember that there's a preference. If a taxpayer generally has, in general, a taxpayer, if they have a gain, they want long-term capital gain, but if they have a loss, they want ordinary loss. And the reason for the capital gain is because long-term capital gain usually will result in preferential rates. Ordinary losses have less limits than capital losses, and also being able to offset an ordinary income with ordinary loss gives a greater tax benefit. So we want to get long-term capital gain if we have gain. So keep that in mind for this video. We want long-term capital gain if we can get it. Okay? And that's a lot of what you're going to see is specific, the problem and the solution when applied with Section 1245. So keep that in mind. We want to get long-term capital gain if we have gain. So here's the problem. In the other characterization videos, we talked about sale or exchange. To generally get capital treatment, you have to have a sale or exchange with respect to a disposition. Now, you can have involuntary conversion if you go through Section 1231. But those are really the only ways that you potentially could get capital gain or capital loss. Sale or exchange is the normal rule, and there's one little carve out for involuntary conversion in Section 1231. What if you don't have sale or exchange? Okay? So what I'm talking about here is every income, loss, deduction item can be characterized some way. So what if you're simply depreciating property? If you're depreciating property, are you selling, exchanging, or do you have involuntary conversion? No. Depreciation is not a sale or exchange or involuntary conversion of property. Depreciation is simply just recording a deduction related to the economic obsolescence or wear and tear on property that we have through the tax code. We have a set of rules of how we actually quantify that. We depreciate it. Okay, very similar to our accounting method for depreciation. So depreciation is not a sale or exchange or involuntary conversion. So that means it can never be treated as capital character. So whenever a business, or if you have investment property and you have depreciation or amortization, it's going to be an ordinary deduction. An ordinary deduction on the tax return. An ordinary deduction. Okay, that's going to be, remember, in previous depreciation amortization videos, you can get depreciation through trade or business activity or investment. You can't get it on personal activity property, right? That's very important. That's from the big three with respect to the deductions. Please see that video that discusses what exactly trade or business, what exactly investment is. Very important concept to understand. Again, you can't get depreciation on personal activity property, like your personal house, your personal car, right? You don't get to depreciate the car you drive around personally. Okay, so that's the important part. Ordinary deduction. Okay, it's an ordinary deduction. Again, trade or business investment. Now, what happens if we sell that depreciable property later on? So if we sell that depreciable property later on, so during the life we were depreciating it, we were getting ordinary deduction. Okay, let's say it's business property. Let's say it's business property. And we sell it. Let's say we depreciate it. We purchased it 5 years. We've been depreciating it over those 5 years. It still has 2 years left to depreciate. 3 years left. It's 7-year property, but it's going to be depreciated over 8 years. We sell it. And when we sell it, let's say the property results in Section 1231 gain. Or just straight up long-term capital gain. Remember that Section 1231 can potentially result in long-term capital gain. Okay, under the main hodgepodge. See that video to refresh your memory. Or it could just be straight up long-term capital gain. Maybe it's investment property. which is a capital asset. We're selling it, right? And if it's been held for more than a year, which it has because we bought it 5 years ago, right? It could be 1231 gain or long-term capital gain. So you got these ordinary benefits, but then when you sell it, you get this preferential treatment through long-term capital gain or Section 1231. So the problem is that Congress saw this as an abuse mechanism. People were getting this ordinary deduction, and they were lowering their tax rate. They were getting a tax benefit, right? They were lowering at 40% or more, but then long-term capital gain came around, and they were being taxed at 20% tax rate. Do you see the issue? You were basically netting a positive 20%, okay, over that period of time. Because depreciation reduces basis, and that's a recovery of capital. And as your basis goes down, when you sell it, you don't get to recover that upon sale. So the idea is that it's a matching issue. The problem is that it's not matching, does not match correctly. And Congress said we have to come up with a solution for this, which really, in your mind, you should be thinking anti-abuse, because people were taking advantage of this type of idea. The matching issue, which doesn't match, is that over the life, you've got an ordinary deduction, but upon selling the property, you potentially could get 1231 or long-term capital gain, which is a 20% tax rate. So it was just too good to be true. So the solution came through a case called Aerosmith, which is also known as the Aerosmith Doctrine. So it's a Supreme Court case. We just call it the Aerosmith Doctrine because it's one of those seminal cases in tax. Well, it's probably one of the top 25 cases in all of tax law. It's called Aerosmith. And what Aerosmith says is that, and I'm just going to summarize it. I strongly recommend looking at the case, looking at the actual case. You can even just go online and look at a summary to get a good idea. It's all about matching. You have to match the benefits. You have to match the benefits received with the burden or gain later on. So you match the benefits with the burden, we'll say. So the ordinary depreciation, okay, we get ordinary depreciation over the life. We get ordinary depreciation. If we apply the Aerosmith Doctrine to the ordinary depreciation over the life, then when we sell it, so let's say later on we have a sale, we sell, when we have a gain, part of that gain also needs to be ordinary. We have to match it. So there's really two ways to address this. We can make the depreciation deductions long-term capital or 1231. So we change the benefits or we change the burden. It's easier to change the burden because if you do the benefits, you don't know how long you'll have held the property when you sell. You don't have a crystal ball. You can't go in the future and say, okay, well, I'm only going to hold the property for 6 months. It's going to be short-term capital gain, which is taxed at ordinary income rates. So it's all about the solution to this under Aerosmith is all about matching the benefits with the burden. The burden being the gain, right? Because gain creates tax. The benefits are ordinary depreciation, which reduce your taxable income. And depreciation deductions, they are going to be ordinary character. Again, because there's no sale or exchange. All right? So we're going to have to recharacterize, and that's what recapture means. We're going to have to recharacterize. Recharacterize part of or all of the gain as ordinary. Because, again, we have to match the benefits with the burden. Benefits with the burden. That's what Aerosmith Doctrine is. And the Aerosmith Doctrine can be applied to other things as well. It can be applied to what if you got a credit during a life, but then upon selling you get some other thing and you have to match. Okay? You get some type of credit. Well, credit is a dollar for dollar, and then when you sell, a gain is just taxed at the tax rate. Okay? That's another area where Aerosmith comes into play. Aerosmith comes into play a lot. And that's what Section 1245 is. Section 1245 is a specific carve-out or codification. Specific codification of Aerosmith. It's a recharacterization rule. Okay? So Section 1245 actually came after the Aerosmith decision. And Section 1245 is a recharacterization rule. So even though we call it a Section 1245 recapture, it's a recharacterization. And what recharacterization means is that when we sell the property, it's possible that Section 1231 gain or long-term capital gain that we determine might be recharacterized as ordinary. As ordinary. That's what you should be thinking in your head. Recharacterization means we might have to recharacterize some of our gain as a different character than what under the general rules. So let's go ahead and go through the actual requirements. And when you go through the requirements, I went through the problem solution. When you go through the requirements, I think you'll understand more the problem and solution, how it applies with respect to depreciation and amortization. So recall again that depreciation results in an ordinary deduction because there's no sale or exchange. Same with amortization. If you're amortizing property on the tax return, that's going to reduce ordinary income on the tax return. So if you're an individual and you have a sole proprietorship and you have some buildings that are depreciable, okay, or you have a truck that's depreciable that you're using in your business, that's reducing your ordinary income, the business income. That's ordinary, not capital income, ordinary income, which that's good because it's at a higher rate, the ordinary income is, and we're lowering that down. So that's a good thing. So the first requirement is that we must have a disposition, okay? And when we think of disposition, you're probably thinking, oh yeah, we've been talking about this. This is the sale or exchange or involuntary conversion. And you are correct. A disposition means that it's been disposed in some way or some method by the taxpayer. But there's actually more. There can be other things, abandonment, other types of items where sale, exchange, or involuntary conversion do not cover everything. But sale, exchange, and involuntary conversion makes up about 99% of the dispositions. Okay? So disposition, which really, in your head, think of sale, exchange, or involuntary conversion. So that means that if you have something in Section 1231, you're potentially going to have to worry about Section 1245 because that only applies to sales, exchanges, or involuntary conversions. Involuntary conversions in the fire pot, right? And if you have a capital gain or loss, right, it has to be a sale or exchange. So this really covers anything that can be capital. That's why we're saying sale, exchange, or involuntary conversion has to be a disposition. Sale, exchange, involuntary conversion. And that's really what Section 1245 gets at. It gets at 1231 and also long-term capital gain treatment, which comes through sale, exchange, or involuntary conversion. Okay. So really, that's what you need to be thinking in your head. That Section 1245 applies to sale, exchange, or involuntary conversion. One of those. That's what disposition should mean to you. Okay. So the next requirement is that we must have a gain. So Section 1245 never applies to losses. It only applies to gains. And even more than that, it has to be ordinary. Okay, so you determine the gain, right? You go through the realize, recognize calculation, okay? And you determine that there's a gain. There's a realized gain. That's what I always look at. Look if there's a realized gain. And you go through the classification. You go through the classification, and that gain would not be ordinary. Again, it would be capital. Okay, it would be capital. It would be 1231. It's going to be if it's capital or 1231. If it's ordinary, you don't have to worry about Section 1245 with respect to the specific item. Now, for Section 1245, it applies to every specific transaction. It's a transactional approach. So you have to have gain that's not ordinary. You can't have a loss. Okay. The next item, and this is very important. Okay, and I'll talk about this at the end. But the next item is that you must have personal property. It must be on personal property. So the sale, exchange, or involuntary conversion that resulted in gain that's not ordinary must be on personal property, not real property. Do you remember the distinction between personal and real property? Real property is the land and everything attached to the land. Personal property is everything else. So personal property can be tangible or intangible. Real property can only be tangible because it's the land and everything attached to the land, so it has to be tangible, it has to be touchable. Okay? All right? So if we have a disposition, a gain that's not ordinary, and personal property, the next requirement, this is really the last requirement, until we actually have to do the recharacterization calculation, is that there must have been, or the property is subject to depreciation or amortization. So it's depreciable or amortizable property. Depreciable or amortizable property. And even if you decided not to depreciate or amortize, we talked in a previous video about in the adjusted basis videos about allowed versus allowable depreciation. Same with amortization, it applies the same way. If you didn't depreciate or amortize, still it's subject to this because of that allowed versus allowable issue. Okay, that was in the adjusted basis video. You can take a look at that, the allowed versus allowable issue. Okay, so if we have a disposition, and we have a gain from that disposition that's not ordinary, and it's on personal property that's depreciable or amortizable. Well, now we have to recharacterize. You now have gotten to, okay, these are all the requirements. Now you have to recharacterize potentially any long-term capital or 1231 gain. All right? We have to recharacterize. We have to recharacterize or recapture. That's what the term recapture comes from. So recapture simply just means recharacterization here. We recapture, recharacterize. The capital or section 1231 gain, because we have a gain, right? And it's going to be recharacterized, and this is important. This is where we get the problem and the solution, right? Where we have to match. Again, think of the problem. When we took depreciation or amortization, because we didn't have a sale or exchange during that time, it was an ordinary deduction, which lowered our ordinary income. So that means that the depreciation and amortization gave us an ordinary benefit. Upon the sale, which is when we dispose of the property, we have to match. That's what Aerosmith says, and that's what section 1245 is a codification of. So now we have to recharacterize the capital or section 1231 gain as ordinary, and it's a certain amount, as ordinary gain, ordinary income, as ordinary. And that's the important part. That's the important part. And it's the lesser of. The amount that we recapture is the lesser of, and this is very important. It's the lesser of the realized gain or the total amount of depreciation or amortization taken over the life of the asset, on that asset. So it's the lesser of that amount, okay? So let me just give an example. Let me do two little examples, two simple examples. Let's say that you go through all of this. We have, let's say, a sale or exchange, and the gain is not ordinary. Let's say that you have, in example 1, you have a gain on personal property that, let's say, is depreciable. Okay? And let's say you go through all the analysis, and you determine that, let's say you're selling some equipment. Actually, no. Let's do that. Let's say you're selling a car that's an investment car. I know it sounds a little crazy, right? Maybe you own a car that has investment on it, and you took depreciation on it, right? So it's an investment car, and let's say that you sell it and you held it for more than a year. It's personal property because it's a car, right? It's depreciable. It's a car, even if it's an antique or whatnot. And let's say you have a $10,000 long-term capital gain, and let's say you took $6,000 of depreciation. You took $6,000 of depreciation. All right? If we go through this analysis, all right? If we go through the analysis, we take the lesser of the realized gain, which let's say is the $10,000, right? That's the realized. Let's say the realized was the recognized in this transaction because it was a sale. It was a sale for cash. So the realized gain was $10,000, or the amount of depreciation, which was $6,000. So we take the lesser of that. So the lesser of the realized gain, which is $10,000, or the total amount of depreciation taken over the life, which is $6,000. So that means $6,000 is going to be recharacterized as ordinary, and the remaining $4,000 is going to be treated as the original long-term capital. So that's what recharacterization does. It takes this long-term capital gain or 1231 gain, and it recharacterizes it because, again, you got the benefit of the depreciation, which provided the ordinary deduction. The way that we fix that is we match. We say you got $6,000 of ordinary deduction benefit, all right? Well, you got that over the life. Now you're going to have to pay $6,000 of tax on ordinary income to match it. Now, there's an issue of timing, time value of money, right? You got that benefit earlier on, which was time value of money, but obviously the government, they can't do anything about that. They could try charging you interest, but that would be ridiculous. And then you bring up claims like, well, what interest rate would you use? Things have changed over time. The economy's changed. Okay, so that's an example of a long-term capital. Let me show you an example. This will be example 2. Let me erase this. Example 2 deals with section 1231. So let's say that we have a business and we sell some property, some equipment, and we get a $15,000 section 1231 gain. We sell this, right? We're selling this. Okay, we go through this. We have a disposition because we have a sale. We have a gain. That's not ordinary. It's 1231. It's personal property. It's equipment. It's depreciable. We depreciate it. And let's say that we depreciated $10,000. We depreciated $10,000 over the life. So again, it's the lesser of the realized gain, the $15,000, or the amount of depreciation, which is $10,000. So $10,000 of the section 1231 gain will be ordinary, and $5,000, the remaining, will be 1231. And guess what happens? We have to do this step. We do this before we net in 1231. So remember in section 1231, if you don't remember section 1231, please stop and rewatch this video. Okay? Or rewatch the section 1231, then come back to this. But in 1231, in order to determine the ultimate character of the gains and losses that go into section 1231, we have to go through the netting. We have to net all the 1231 gains and losses in the hodgepodge. All right? And when we net those items, if we net and it's a positive, then all the items in the main hodgepodge become capital, long-term capital. But if it nets to a loss, then everything's treated as ordinary. So we actually have to do this 1245 recapture before we do section 1230, before we do 1231 netting. Okay? So it's important to understand that. We apply section 1245 before we apply section 1231. Now we have to characterize as 1231 first, but I'm talking about the netting. So we apply section 1245 before we net. That's the key. Before we net. It's all about timing. That's the hard part that students generally have when they first learn about characterization. Where does everything fit in? Well, 1245 comes before we do the 1231 netting. Now we have to know what is 1231. We have to know, okay, this is going to be 1231 gain, but we have to do 1245 before we do the netting. Because we pull out that ordinary income from that would be 1231, but then we bring that $5,000 over, and guess what? That $5,000 versus the $15,000 can change things around. Because this is a gain of $5,000, that 1231 versus 15,000 of 1231, that potentially could affect our numbers in the hodgepodge. See how that makes a big difference? It's very important that we do this in this order. So we do 1245 before we do the netting of 1231. Very important to understand. Okay? So I showed you two examples of 1231 and long-term capital and how it works. Now, if we had if the depreciation amount was more than the amount of the gain, so let's say I changed around the examples here, and let's say the depreciation in example 2 was $20,000. There was $20,000 taken on some equipment. Well, then the full 1231 gain would be ordinary. All of it would be ordinary. And the reason is because it's the lesser of the realized gain, which is $15,000, or amount of depreciation, which is $20,000. So when the realized gain is the amount you use, guess what? All the 1231 or all the long-term capital becomes ordinary because the lesser of rule. And that's only fair because you shouldn't have to take in more. Even though you got $20,000 of tax benefit, you only have $15,000 of gain. You can't create an extra $5,000. That wouldn't be allowed. That's not what Aerosmith is about. Aerosmith is simply just recharacterization. It's just changing around that 1231 gain. So the $15,000 of the 1231 gain, because the lesser of rule applies with the realized gain, all $15,000 is considered ordinary. We recharacterize it as ordinary gain. There is no portion of one versus the other. It's all because of the realized gain is less than the amount of the $20,000 depreciation. Okay, so another thing I want to mention, I mentioned earlier that section 1245 applies before section 1231, always. Okay. Now you have to know again what 1231 items are when you're looking at the general issue of 1245, because you have to know, okay, again, is it going to be ordinary gain? But you don't do the netting yet. Another thing is that section 1245 trumps all other code sections. That's the general rule. So trumps or goes before, or it takes precedence. If you have two rules that potentially could offset one another, 1245 is what trumps. 1245 trumps all other code sections. That's the general rule. It says it in section 1245. But there's a few exceptions. And I'm just going to lay out some of them, some of the exceptions. You need to go, if you want to look for more of them, please look in the code. One example is gifts. So gift, which some people say is technically a disposition, because even though it's not taxable, because it's not taxable to the party when they give it. Now, there might be a gift tax, but that's separate from income tax. But gifts, even though someone's disposing of the property because they're gifting it to someone else, they have, there's no gain or loss, but section 1245, again, it trumps all other sections. So the question becomes, okay, well, the gain that's in there, does section 1245 does it make them have to recognize gain? And the answer is no. An exception is gifts. No section 1245 applies to gifts. Another example, some of the non-recognition rules we've been learning, including 1031. So most non-recognition rules, section 1245 does not apply to. Now, there's a few that it does. That's why I'm saying most. But for example, like-kind exchanges, section 1245 does not apply to come in and make something recognized. There's a few exceptions to that, and you'll see those in later discussions. But it's important to understand that most non-recognition rules, like-kind exchanges, when you form a business, those rules, they do not trigger section 1245. Okay. Now, the last thing I want to mention is we talked about how this applies to personal property that's depreciable. You might be asking, what if you have real property that's depreciable, like a building, and you have business or investment property? Well, there's a provision called section 1250. And section 1250 deals with real property. At one time, section 1250 really did do this, but it didn't do the same way it does here with the lesser of the realized gain or the total amount of depreciation or amortization. At one time, we had accelerated depreciation for real property. It was accelerated. It wasn't straight line. It was accelerated. That time is no longer. Now, all property that's in place is now based on straight line method. So section 1250 has now been basically, it's still in the code, but it's technically obsolete because it really focused on recapturing when you weren't using straight line, you were using an accelerated method. And it really did the same thing. It was the same approach. It recharacterized a portion of the income as ordinary and not 1231 or long-term capital. Now, there is still some relevance of section 1250. In the capital gain and loss mechanics video, I mentioned that there's something called unrecaptured, and you need to know this. Okay, unrecaptured section 1250. Unrecaptured section 1250 is still considered long-term capital if that's how it's been characterized. Okay? It's still considered long-term capital gain if it makes it that far. And if the 1231 is treated that way. But it has a special rate. You'll learn more about that in the capital gain and loss mechanics. So this really concludes our video. Again, you see the problem that we have an ordinary deduction during the life, but upon disposition, you get this preferential treatment. Congress said, no, that's too good. We have to match it. So you got the benefits of the ordinary deduction during the life. Well, upon sale, you also have to get the ordinary, the worst rate. So we have these requirements. Disposition, a gain that's not ordinary on personal property, that's depreciable or amortizable. We recharacterize the lesser of the realized gain or a total amount of depreciation or amortization taken over the life. And we saw some examples of how that works. Now we apply section 1245 before section 1231, and then section 1245 trumps all other provisions unless there's a few exceptions, gifts, most non-recognition rules. So I hope you enjoyed this video.